Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major trading opens.
And I'm Paul Allen. The top stories this hour. 10-year Treasury yields climb the highest since November as traders position for the US inflation numbers. Markets now favouring just 2 Fed rate cuts this year.
Oil prices are easing, with Israel pulling some troops from Gaza and flagging progress in talks on a ceasefire and hostage deal with Hamas.
And Japan's Prime Minister arrives in the US as the AUKUS alliance seeks a closer partnership to counter China.
We'll take a look at how we're setting up ahead of major markets coming online in the next hour or so. We're seeing AS51 futures. They're looking pretty positive, about 0.5% higher there. More broadly across the region, we are expecting stocks really to advance in the Tuesday session, following on the back of US benchmarks that did see pretty sluggish trading and not very robust volumes, but certainly that caution kicking in before the US CPI data. Treasury is kicking off this week on the back foot ahead of that CPI print. Very much looking ahead to that as the key data of the week. Traders now, if you're wondering, they're favouring 2 rate cuts by the Fed this year. So we'll see if some of that repricing happens when the data comes through as well. Japan futures looking a little bit sluggish at this point, looking pretty flat trading in Chicago. Nikkei futures, that is, and FTSE A50 China futures up by just about 0.1%. Paul.
Okay, we got US futures trading in positive territory. It was a very light day for US markets. The day just gone, very light volumes. We had a mixed close. I don't know, might be fun to blame the solar eclipse. But the S&P had its smallest move this year. And as Heidi mentioned, their market's now just pricing 2 Fed rate cuts. So markets really looking for a catalyst here. In terms of the oil price, we saw that recover as well. It did slip on the news that Israel's looking at moving some troops out of Gaza, but since recovered some of that ground. We did see Brent go back above 90. We got New York crude at the moment trading a little bit higher, 86.66. So the supply-demand dynamics that underpin that move higher, really you've got to say it hasn't changed a great deal, Heidi.
Let's bring in Will Curtain, who's a portfolio manager at Milford Asset Management. Well, always great to have you with us. So we've talked about kind of the risk of higher for longer and the Fed having to walk back these easing expectations. Do you think it's a pretty high bar for them to have to do this?
Yeah, we think genuinely the Federal Reserve wants to cut rates. They started that narrative back in October, November. Why did they start that narrative? Likely because the inflation was moderating towards target. There was a view that the economy would weaken. And ultimately, we believe that the government needs cheaper funding costs to help fund this large fiscal deficits and the large government debt position. Since then, unfortunately, for the Fed, inflation is slowly accelerating, the economy is re-accelerating, and it's getting a more and more difficult window to cut rates. But the Fed does not want to U-turn on its promise and its forward guidance of rate cuts. So it's just pushing those cuts out. And for the time being, that's very supportive for equity markets with growth accelerating and still a view that rate cuts will come.
The balance of risks, not just for the Fed, but for other central banks, including the RBNZ, the RBA, seem so finely balanced that it's difficult to kind of see the trajectory forward, right? Do you hedge in sort of non-equity assets at this point?
Yeah, I mean, the immediate beneficiaries of the narrative of rate cuts coming were sort of equities led by technology stocks and empowered by the AI boom and narrative and technology stocks. But we think the longer that goes on and the more the US economy accelerates, and even some of the downside in terms of the economic data for the European Union hasn't played out. We believe that the sort of bull market broadens and spreads into resources and commodities, and that's what we're starting to see occur at the moment. There's likely a manufacturing restocking or inventory restocking cycle underway. Metals like copper are going to benefit immensely from building centers from AI and the investments to support renewables. So we think for investors, now that the valuations are pretty toppy in technology shares and equities in general, we think actually a mix of commodities, whether it's copper, gold, various resources companies, are a very good hedge for a portfolio, as they will do very well in the environment where growth keeps accelerating, inflation keeps accelerating, and the central banks, mainly the Federal Reserve, do not lean against that inflation and fight it. And that's actually ultimately one of the very big bull cases for gold.
Yeah, I want to get to gold in a minute, but just in terms of your views on commodities, we've seen a pretty good run for the oil price recently. We did see a bit of a pullback yesterday, but a couple of questions here. A, do you invest in energy stocks? And secondly, what are the implications for the inflation picture if oil keeps rising?
Yeah, I mean, in the last bit first, obviously, gasoline prices are already coming up. It's one oil, but it's also refining capacity relatively constrained around the world, with a lot of Russian refineries, sort of that refined product not hitting the global markets. Means that it is going to create problems for headline inflation and a re-acceleration in inflation numbers. Again, it's yet another reason why having some energy stocks in a portfolio is a good hedge on that inflation returning. Yes, we own energy companies, refiners and oil and gas producers. In general, you can still get pretty good cash flows from these businesses. A company like Shell at current energy prices has got a free cash yield of sort of above 15%. We don't necessarily think oil prices are staying above 90 long term, but they're likely to be at reasonable levels that many of these sort of leading energy producers will produce strong cash flows as long as oil's staying above 80, which we think in this economic backdrop is pretty likely that energy can remain above 80, certainly until OPEC plus decide to turn on the taps again.
You mentioned gold a minute ago, and we've just got the gold price up on the screen while you're talking. It is pushing higher again. Now, this has been something of a conundrum for a number of market watchers. I'm wondering what your opinion is on why we're seeing gold moving higher right now.
Yeah, I mean, ultimately, I think it's very central bank driven. If you do have inflation coming back, even if modestly coming back, and economic growth accelerating, but you've still got central banks like the Fed looking to cut, then you're just devaluing fiat currencies. Ultimately, that's why Bitcoin's doing well as well, because it's perceived to be a store of wealth outside of fiat currencies by a lot of the people who play in the crypto space, and it's why gold is doing well also. On top of just what the central banks are doing, you also have a case where there seems to be a lot of demand picking up for gold in China, and that's not just from the Chinese central banks and other central banks around the world looking to diversify their reserves away from US dollars, but it's also by retail investors in China. And they're in a situation in China where consumer confidence is very low. There isn't much appetite for the Chinese equity market at the moment. Property is no longer the destination for a lot of those consumer savings, given nervousness around the property market. So they're seeking for other places to put their wealth, and they don't necessarily want it all in the bank or all in currency. So they're seeking out alternatives, and gold appears to be becoming more and more in favor. And if that dynamic continues, then you can see quite a bit of upside for gold still. Obviously, short term, it's had a big run, and it's generally prone to sharp reversals after having such a sharp run that it's had now. But there could be still a lot of support over the next 12 months for gold.
Is the confidence spiral for China, I guess animal spirits, for want of a better term, what you're most concerned about? Or are there other aspects where you think that there is sort of investable opportunities in China still?
Yeah, well, we still think China's a big resources consumer, even with the property market weak. They're looking to really accelerate the manufacturing sector, and whether it's renewables, whether it's auto manufacturing, they even appear to be trying to start a replacement cycle of appliances and so on. And all of that's pretty supportive for copper demand and resources demand. So we generally think resources are still, despite this negativity in China, is actually going to do quite well on the backdrop of what's happening there. When it comes to the China's consumer, there is a negative confidence cycle. They're feeling fairly beaten up. They're feeling that the policy support isn't enough to re-accelerate the economy in a big, broad way. So there is a huge amount of built-up savings by the Chinese consumer. It is seeking out gold, but if the policy support came in a bigger way, if there was a lot of loosening of the monetary conditions in China, then I think you would eventually pull some of that big savings by Chinese consumers into other asset classes, be it Chinese equities or property again, and that would cause a big boom. So it's not necessarily our base case. There's an immediate big loosening in Chinese monetary policy, But we think as the year progresses, the policymakers may be forced to keep easing those conditions quite drastically, and that could create a contrarian sort of turnaround in a lot of Chinese plays.
All right, William, we'll have to leave it there, but thanks so much for joining us this morning. That is William Curtain, Portfolio Manager at Milford Asset Management. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go. This is also available on mobile in the Bloomberg Anywhere app. And once you're there, you can customize your settings so you're only getting news on the industries and the assets that matter to you. This is Bloomberg.
We continue to be concerned about the role that any firms, including those in the PRC, are playing in Russia's military procurement. I stress that companies, including those in the PRC, must not provide material support for Russia's war, and that they will face significant consequences if they do.
US Treasury Secretary Janet Yellen wrapping up 4 days of talks in China with a warning against any moves to bolster Russia's military capacity. Our Chief North Asia correspondent Stephen Engel joins us now for more. So there were modestly set expectations from this visit. How would you assess, I guess, whether it was a successful trip?
Yeah, success is a difficult one to essentially measure in this case. Janet Yellen obviously had an agenda to bring up issues about overcapacity in green industries and the threat of dumping by the Chinese on global markets and the distortions. We'll talk about that in just a minute. But sort of wrapping up this 4-day trip to Beijing, talking about China's cozy relationship with Moscow as it relates to supporting or whether it is supporting the war in Ukraine. And again, Janet Yellen did say that most of the increased trade that we've seen, obviously, over the last couple of years between China and Russia has been, quote unquote, non-problematic. Her threat, if you want to call it that, or her warning to Beijing is that they're going to be on increased watch for any potential aiding of the war machine, if you will, in the Ukraine, and warning banks, any banks that facilitate significant transactions that channel military or dual-use goods to Russia's defense industrial base, expose themselves to the risk of U.S. sanctions. And again, the ultimate weapon of the United States would be cutting off Beijing, like it has done to Russia, access to U.S. dollars. But that's an ultimate threat down the road, obviously. And again, there's been not necessarily any exposed proof that Beijing is supporting the war in Ukraine, and China's role or explanation has always been that they are neutral. But there's no doubt that trade between Moscow and Beijing has increased considerably over the last couple of years. But the timing is interesting as well for her to raise these comments, because it came on the same day that Russia's Foreign Minister Sergei Lavrov arrived in Beijing for talks.
Let's get to Janet Yellen's press conference. She was saying there that the global economy might be adversely impacted by these ramped-up factory exports from China. What was Beijing's response to that?
Well, first, I'll take a step back, and obviously this is a push by Xi Jinping with a slowing and sputtering Chinese economy, the emphasis on new industrial forces, and in particular the new three, that's EVs, batteries, and solar panels and the like. And again, the concern that Janet Yellen raised in her trip to Beijing was about the overcapacity and the investment, if you want to call it, subsidies into these industries, and that excess capacity has to go somewhere. If the domestic economy is not picking up, it goes abroad in the form of cheaper exports, and that distorts global trade. That is, in a nutshell, the argument. Xinhua news agency, well, let me back up for the first of all. So far, Beijing has been playing nice and listening to these complaints across the table from Janet Yellen, and has not, according to U.S. officials, has not blasted her across the table as a rebuttal. But again, we have heard from Xinhua news agency in a commentary Friday. They blasted Yellen's quote-unquote xenophobic narrative of Chinese excess capacity. And also the vice finance minister, Liao Min, pushed back saying that the current production capacity is far from meeting market demand. This is an issue, obviously, in an election year in the United States, is not going to go away.
All right, Chief North Asia correspondent Stephen Engel there. Right, TSMC's US-listed shares ended higher. This is after the Biden administration said it's awarding the company more than $6 billion in grants and as much as $5 billion in loans. This is to help it build factories in Arizona and boost domestic chip production. So for more on this, let's bring in Bloomberg Intelligence Asia-Pacific technology analyst Masahiro Wakasugi. So Masahiro, what's the possible impact of this grant on the semiconductor sector, particularly in the US?
Good morning. Yes, we think that that's a good decision. And in the past, so far, we had the total amount of the CHIPS Act subsidy. But recently, we are seeing that some portion will be allocated to the specific companies like TSMC. So this will may accelerate the capacity expansion for TSMC or maybe Intel in the U.S. region. So in that case, U.S. companies should be able to procure the semiconductors more easily going forward. So probably we will hear some more chip factory capacity expansion in the U.S. And also, maybe if we look at the U.S. companies, for example, AMD or Qualcomm or these companies, including NVIDIA, they will be able to procure, especially like 2-nanometer chips. And in this case, TSMC may be targeting the very much advanced technology 2-nanometer chips. So that should be good news for the U.S. chip fabless companies.
In terms of the ability to scale up and the timing, do you think the US can regain that competitiveness? What are the risks to that ambition?
Yes, if we see the timing of the capacity expansion and the technology evolution, probably TSMC should be starting the most leading edge technology in Taiwan. But probably 1 year or 2 years later, that technology will be shifted to US. So in that case, should be okay. But if we just really look at the most high-end technology, maybe still located only in Taiwan. So in that case, there may be a risk. And if we look at the recent earthquake in Taiwan, I think that U.S. companies may feel a little bit of concern for the procurement of the most leading edge technology chips. So in that kind of global location of the diversification of the location should be one issue going forward.
Bloomberg Intelligence Asia-Pacific technology analyst Masahiro Wakasugi there. Japanese Prime Minister Fumio Kishida is in the US for a state visit. He's set to meet with President Joe Biden on April 10th. Our East Asia government editor, John Herskovich, joins us now for more. And John, so what's President Biden looking for in this meeting with Prime Minister Kishida?
Well, Biden is looking for an enormous array of help from Kishida on so many different issues, from security to economics. And this is such a key partner for the U.S. There are going to be things that are talked about from the security front. Biden is looking for help with regards to China, with regards to North Korea, and also on the economics front, getting things like supply chains that are less dependent on China. There may be some agreements on nickel procurement. On the security front, we're going to see the term that's being bandied about a lot is latticed. The U.S. is trying to get more interconnection between partners like Japan and other nations to help it in various regions, like the South China Sea.
We're also hearing that Japan could potentially be looking at joining the AUKUS Pact, that is Pillar 2, which is the non-nuclear part of this. Yes. What are you hearing, and what's the likely time frame for this happening, if it does happen?
Well, I think we're going to get some discussions on this at the at the meeting. The Tier 2 is not the nuclear submarine, as you mentioned. It's information sharing. It may be with other countries such as New Zealand. We'll probably get a few more details about this coming during the summit, but it would expand AUKUS, the Tier 2, the lower end of it, to include Japan as a partner. And Japan is trying to increase its ability to do various things on the security front. It's in a joint venture for the first time with jet fighters with Italy and the UK. So this will be part of the information sharing, the defense sharing, that could help Japan make that next step to be more and more of a player in the international market in the defense industry.
All right, East Asia Government Editor John Herskovits there. And we have heard from the Australian Prime Minister Anthony Albanese. He's been holding a press conference this morning. He says there is no plan to expand AUKUS beyond the 3 countries, but one assumes he's talking about the Pillar 1 part of the AUKUS pact, which involves the sharing of nuclear submarine technology, which would obviously disqualify Japan. So Albanese is saying there's no plan to expand AUKUS beyond the 3 countries, but that potentially doesn't rule out Japan joining Pillar 2. Plenty more to come on Daybreak Australia. This is Bloomberg. All right, let's get the latest geopolitical news. Senior Israeli officials say progress has been made in negotiations for a ceasefire in Gaza. And that would include the release of hostages and Palestinian prisoners. The defense minister says Israel has reached an appropriate point for difficult decisions on returning hostages held by Hamas. Israeli media say a meeting of the Security Cabinet has been called for Tuesday. Germany is said to be forging ahead with a sweeping military overhaul costing as much as $7.6 billion. Sources say the ruling coalition wants to order hundreds of armoured transport vehicles and 2 additional Navy frigates. It's part of Germany's push to modernise its military following Russia's Ukraine invasion and will require approval from lawmakers in Parliament. Heidi.
Take a look at how US futures are shaping up, and this is we're hearing from the Minneapolis Fed President Neil Kashkari weighing on this recent data that we've had when it comes to the US labour market being so robust. Kashkari is saying the labour market is no longer, quote, red hot, but still tight. These are comments that he's making in a town hall, and Neil Kashkari had fairly recently also talked about the idea that interest rate cuts may not be needed at all this year if progress on inflation stalls, especially if the economy, including the labour market, remains robust. So there's some question about that, particularly in a week that goes into that key CPI print that we're expecting from the US. You're watching, of course, a town hall that's taking place with Neil Kashkari, the Minneapolis Federal Reserve Bank president there, talking about the labour market still very much tight, but no longer what he categorises as a red hot. We'll continue to monitor that, but of course this going into some degree of caution as we see across US futures at the moment. Pretty unchanged kind of muted session that we had in the previous trading session to light trading volumes. Investors really prepared for that busy week of eco data, bank earnings as well, slated for the end of the week. So a fair degree of caution, as you can see. The big moves really, of course, were across bond markets, treasury markets kicking off that week very much on the back foot. A combination of geopolitical pressures and positioning for the inflation data, sending 10-year yields to the highest since November. Well, coming up next, hear why National Australia Bank says the increasing risk of yen intervention is justified by fundamentals. We get their outlook across broader currency markets next. This is Bloomberg.
Let's take a look at how we're tracking on foreign exchange markets at the moment. There's not a huge amount of movement right now, but we have been hearing some remarks from the Fed's Neil Kashkari. He's saying the labour market's no longer red hot, but it's still tight, and the Fed can't stop short on its inflation fight. But it was, of course, Neil Kashkari that mentioned a few days ago that he does foresee a possible scenario where the Fed doesn't cut at all, and that's been helping to support the US dollar. And as a result, been helping to weaken the yen as well. And we see the yen weakening again right now, moving ever closer to that 152 level that a number of market watchers think could be the trigger point for potential intervention. Well, the timing of the Bank of Japan's next rate hike is also in focus as Governor Kazuo Ueda begins his second year in charge. Let's get some more perspective for the yen with Rodrigo Cottrell, a senior currency strategist at National Australia Bank. Rodrigo, thanks for coming in and joining us here. I want to talk a little bit about the yen. I mean, we do see this distinct lack of urgency from the Fed when it comes to delivering these rate cuts that we've all been so eagerly anticipating. The expectations just keep on getting wound back. We've got a stronger US dollar. When do you potentially see yen intervention happening?
Well, I think that over the very near term, what happens to the CPI print this week and the PPI will be super important, because that will really determine whether we really push out those expectations of Fed easing even further. And of course, we see Treasury yields trade higher. You know, we're now very close to testing 450. Once we test 450, I think there's plenty of room to keep going. And that, of course, is a massive pressure on dollar yen to keep rising. And if anything, you know, for Governor Ueda, now the challenge is that the currencies become part of the equation. And our sense is that the bank is right in pointing out that from a fundamental basis, the yen is a little bit cheap. But if you continue to see US Treasury yields trading higher, then that becomes a bigger challenge for them. And intervention becomes, you know, a bigger question and more likely. Our sense is that the market at the moment is underpricing what the BOJ is likely to do this year. But certainly the fact that if you see dollar yen trading above 152 after the CPI, it brings in, you know, make that April meeting very live and may force a hand for the BOJ.
Yes, slowly does seem to be the mantra from the BOJ so far. But in one case, how many rate rises could you potentially see from the BOJ this year? Could it be one, as you suggest, or perhaps more? Yeah,
no, we're thinking more like 3 of, you know, 0.10 basis points of rise over the course of this year. I think that the real challenge for the BOJ will eventually, do you push it above 0.5? But certainly they want to get to 0.5 at some point. And we've got to remember that the domestic backdrop is really, really encouraging. You know, we have wages growth now with the Rengo's third survey, 5.24. So that idea of the virtuous cycle of prices and wages is actually very likely to materialize, with companies also having very, very solid profit margins. So the backdrop for the BOJ to hike is certainly there.
Vicious cycle seems like something you could use to describe yen intervention, right? Yes. Depending on how inflation comes through for the US this week, do you think there's a chance that policymakers might actually hold back? They wait until the buying has been exhausted, because there's kind of no point in going in and doing a little bit, right?
Yes, and at the moment the issue with intervention is the challenge that you need to have a bit of a fundamental basis to do it, otherwise it won't really be effective at all. And that's where, you know, at the moment this vocal intervention, if you like, or threats, is actually doing the job. Dollar yen has just been flatlining at 152 or just below 152 for quite some time. If Treasury yields trade higher, I think that will become harder and they will probably have to step in. But the argument that the yen is cheap on a fundamental basis becomes harder if 10-year Treasury yields are at 455 or 460. And so our sense is that if Treasury yields trade higher, they're probably going to have to allow dollar yen to trade a little bit higher without intervening, because otherwise it's too hard to intervene.
It's not just the yen, of course. We've seen this week a little bit of a recovery, but going into the end of last week, a lot of Asian currencies were pretty close or at their year-to-date lows. Are there any of those that you look idiosyncratically and think there's risk of further weakness there?
Well, the issue around Asian currencies and even the Australian dollar, for that matter, is what's going on with CNY and the policy that PBOC may want to take there. We saw that, you know, move up to 723, so they allowed that depreciation to occur, and it made the market very nervous. So our sense is that we need to have a bit more clarity of what the PBOC is likely to do. Will they continue to defend CNY around 723? And that will bring in stability. And if anything, if you like, the green shoots that we've seen in recent days is commodity prices. They continue to rise, and now we're starting to see a little bit of response, particularly Australian dollar and some Asian currencies responding to that positive backdrop.
Yeah, we saw some good PMIs out of China the other week as well. Do you get a sense that China is turning a corner, or is it just a false dawn?
Well, you know, you look at since the pandemic and those PMIs, you see that big jump when the stimulus comes and then it fades again and we go below 50. We've seen 4 of those events, and it's important to to realize that at the moment the Beijing is sort of very reluctant to bring the bazooka out. But this time around, we think that it's more credible given the commitment to that 5% growth. If they really want to achieve that 5% growth, they need to stimulate the economy. And at the moment, the focus is very much on spending, particularly on the manufacturing industrial side. So our sense is that if Beijing is true to its word, then the PMI rise can be more sustainable this time.
When oil rises, you buy petrocurrencies, right? Is there one clear winner to you?
Well, being an Australian bank, we do like the Australian dollar trading higher. We think that because of its liquidity and accessibility, whenever you see an improvement, particularly in China's economic backdrop, the Aussie dollar becomes very appealing as an alternative for it. And also it's undervalued. When you look at it from fundamental basis, we think that the Aussie is a little bit undervalued here. So any credible improvement to China's growth outlook will be very good news for the Aussie.
Rodrigo, great to have you with us. Rodrigo Cottrell, who's a senior currency strategist at National Australia Bank. And leaving currencies for a minute, taking a look at how we're setting up when it comes to broader equities. We are seeing already a little bit of downside bias when it comes to Kiwi stocks. We're about 25 minutes away from the start of cash trading here in Sydney. Looking like we'll see some modest gains. This as we see bond yields hitting that 2024 high, and really treasuries starting the year on the back foot as we get that anticipated US CPI print this week. We are seeing Nikkei futures a little bit more upside, about 0.2% higher, and broadly some positivity when it comes to S&P futures there as well. We're seeing expectations of a broad advance early on Tuesday morning here in Asia. We're turning to South Korea, and citizens will vote in parliamentary elections on Wednesday that will determine how much power President Yoon Suk-yeol can wield through the rest of his term. Our Korea economy editor Sam Kim joins us now from Seoul. So Sam, what is the outlook looking like when it comes to these election results?
Well, for now, it seems too close to call. There's a lot of polls that indicate that the main opposition party, which is called the Democratic Party, is gaining about 30% in support, whereas the ruling party is gaining about mid 30%. So you might think that, hey, it's the ruling party is going to win the parliament, but there's sort of a wrinkle to this, which is that there's a third party that's been launched by a former justice minister that's gaining about 12% in the latest poll before the election. So we might see sort of an opposition-controlled parliament after Wednesday. And just the fact that the person that founded that third party is kind of more or less aligned with the Democratic Party. So that indicates that, hey, we're going to see something that goes over the majority for the opposition, whereas the ruling party is just going to be able to defend what, barely what the opposition wants to bulldoze through on Wednesday. Yeah.
So what's at stake here for Yoon?
Well, this vote on Wednesday is largely a sort of a vote of confidence in Yoon for the last 2 years of agenda and policies that he's pushed through, which includes his efforts to try to promote stronger ties with the allies, the U.S., also with Japan, and also he's been trying to sort of cut a lot of taxes for property owners, homeowners. And so going forward for the remaining 3 years of his term, it's likely that he's going to try to push more of this agenda. But if opposition holds sort of the majority of parliament, it's going to be very difficult for him to get legislative cooperation. So that means he's going to have to rely a lot on administrative or presidential decrees to get his policies through. And that just means, a lot of more conflict, tensions within the political circle here.
So we've talked a little bit about the economic issues and how a lot of voters will sort of be voting in terms of their wallet, right, their pocketbooks. So what are some of the other issues, social issues, that are top of mind for voters this time?
Well, certainly the one that comes high up on the mind of voters is the standoff between President Yoon and medical doctors. He's been trying to increase medical school students so that the country would be seeing many more doctors in the years coming ahead because, the demographics are aging fast. Right now, there's a stalemate. There's nothing, no progress made right now in terms of negotiations. But if he wins in a certain way, or if he's able to secure enough seats to tell him, to indicate that he's doing well with that policy, certainly I think the stalemate between union and doctors is going to continue and last further, very likely.
All right, Korea economy editor there, Sam Kim, watching the Korean elections. Still to come, the oil rally taking a breather on signs of easing geopolitical tensions. We're going to get BNEF's outlook on crude prices coming up next. This is Bloomberg. All right, let's check in on how commodities are doing. Gold has resumed its upward climb, which is puzzling a number of market watchers, but we've got gold futures now 2,358 an ounce, so knocking on the door of that record. Iron ore prices also back above $100 a tonne. This is the futures contract out of Singapore. On the encouraging data that we had out of China a week ago, also demand for commodities out of China has ticked up since the country came out of its long weekend. This is something our last guest, Rodrigo Catril, alluded to as well. So definitely worth keeping an eye on some of those big Australian iron ore names at the open. Crude prices recovering as well. We did see Brent moving back above $90 a barrel yesterday, and we've got New York crude also climbing right now by 0.25%, 86.65 a barrel. So let's take a closer look at oil. It's obviously in focus. The rally taking a breather on signs of easing geopolitical friction. Traders are now awaiting OPEC and IEA market reports for an update on the demand and supply picture. So for more on this, let's bring in Bloomberg New Energy Finance oil analyst Wayne Tan. So Wayne, what is BNEF's outlook for oil prices?
Thank you. So we are pretty bullish on oil prices at this point. We think that the recent rally in Brent prices above $90 per barrel has more to do with actual fundamentals than the pricing of geopolitical risks. We see a strong increase in crude demand due to the ramp up of several mega refineries, such as Oman's Duqm, Nigeria's Dangote, and Mexico's Dos Bocas refineries, just to name a few. And if you layer that on top of the significant OPEC Plus cuts, we get a pretty overheated market. Now, how overheated the market will remain in the second half of the year hinges heavily on whether OPEC Plus would roll over their production cuts in the second half of this year. Now, even if OPEC Plus were to unwind their voluntary cuts in the second half, the crude market will still be significantly tighter in the second half of this year as compared to the second half of last year, when Brent prices averaged at about $85 per barrel. Should OPEC Plus roll over its voluntary cuts into the second half of this year, then the crude oil market in particular will become very tight, where Brent prices could very well be sustained at the high 90s to above $100 per barrel. So assigning probabilities to each of these scenarios can give us a pretty fair estimate of where crude benchmark prices could be. But the point really is that even if OPEC Plus were to unwind its voluntary cuts in the second half, Brent prices could be well supported at the $85 per barrel level.
What about downstream? Could refinery margins see some improvements in the next few months?
We do not expect to see much upside in downstream refinery margins. The first reason really is increased competition. As mentioned, several mega refinery projects will be coming online. The second point is a little bit more nuanced. So oil product demand will do pretty okay this year. However, a large part of this oil demand growth would come from petrochemical feedstocks, namely liquefied petroleum gas, LPG, and ethane. And LPG ethane can be produced directly from natural gas liquids without the need for refinery processing. And so what you see here is oil refineries not benefiting much from a large part of this demand growth. Now, I will also say that OPEC Plus will continue to keep crude supply restrained. So putting these three factors together, refinery costs would remain elevated, revenue will not see much upside, and margins will remain pretty suppressed.
Bloomberg NEF oil analyst Wayne Tan there. And Paul, we've been watching, this conversation that Jamie Dimon has been having about oil and gas projects, right? In fact, he calls the idea that you can put a stop to all of this production, all of these projects as, quote, enormously naive. He's touting LNG as a boon for the US in his shareholder letter, saying these delays that we've seen in the United States of liquefied natural gas projects are done for political reasons to pacify those who believe oil and gas projects should be simply stopped. And that is a position he calls wrong and enormously naive. This, of course, coming out of a number of different topics that he broached in his annual shareholder letter.
Yeah, it was a very wide-ranging letter, I think, as we've become accustomed to, really. Aligned with that, he addressed JP Morgan's decision to exit Climate Action 100 Plus as well. He's like, look, we've got our own analysts, we've got our own people, we're going to make our own decisions as well. So those remarks on oil and gas really dovetail with that. But no surprise what he felt one of the biggest issues was facing the world at the moment. AI. What's AI got in common with the steam engine, electricity, the internet? He thinks it's going to be that disruptive.
Yeah, it's really quite interesting, all right, talking about, potentially this this idea of these themes sort of coming into fruition and some of the threats and opportunities that we're seeing for the world as well. So talking about the transformational impact of AI, potentially talking about AI in terms of how important it is for their own business, for society at large. They've identified, of course, more than 400 use cases for technology across different sectors and amassed thousands of AI experts and data scientists. They've also begun exploring deploying generative AI within their business as well, according to his letter.
Yeah, hugely disruptive. He's a little bit gloomy in some respects as well. He was talking about the possibility of a soft landing. Market's saying 70-80%. He thinks it's less than that, and rates in a window of 2 to 8%. So a little bit of gloom in that letter as well. Well, you can be sure to tune into Bloomberg Radio to hear more about this, also more from the day's big newsmakers as well. And you can get in-depth analysis from the Daybreak team, broadcasting live right there in our studio in Hong Kong. There's Brian Curtis. In case you ever wondered what he looked like, you can listen in via the app, Radio Plus, or BloombergRadio.com. We've got plenty more ahead. Stay with us.
All right, we are hearing now from Japanese policymakers. The Japanese Finance Minister Shinichi Suzuki speaking again, commenting on the yen, saying he's not judging FX by levels, watching moves with a high sense of urgency, though, and they will not rule out any options against excessive FX moves. Suzuki saying that policymakers will take appropriate action against rapid FX moves, refrained from commenting on factors influencing those moves, and also commenting, saying that the Bank of Japan's Governor Ueda has been appropriately conducting policy and expects the BOJ to work closely with the government. So we are again hearing some of the kind of similar comments that we've had from the finance minister and other Japanese policymakers in terms of the sort of verbal warnings or jawbone, if you will, against dollar yen that have been largely quite effective in terms of at least capping some of the weakness that we've seen in the yen in the last few days or so. We haven't seen outright intervention, and lots of expectation, Paul, that they'll want to wait to see what the sort of fallout is from the US inflation print this week.
Yeah, well, let's talk about Alibaba cutting prices for cloud customers globally by as much as 59%. This is in a bid to win back customers in the hotly contested market. Let's get more with Bloomberg Intelligence senior analyst Catherine Lim. So, Catherine, give us a sense of the competitive environment here and how Alibaba's trying to survive in it.
Well, take a step back. The company already slashed prices back in China, which is the key market for its cloud business, as early as last year. So we've actually seen that price war within China, and for the company to now cut prices outside of China into some of what I would see as smaller markets for the business itself, it doesn't come as a surprise. Clearly, this is a sign that the company wants to actually gain market share in this space itself, and we'll have to actually see how that pans through over the next 12 months.
How does it impact the broader financial outlook for the company?
Well, do you know what? I think if you actually look at the various business of Alibaba itself, this is a smaller component, of course, relative to Taobao and Tmall, which is their traditional e-commerce business. But this is one that could potentially drive, the share price, given so much of the buzz around cloud AI right now. So again, I think from a financial aspect itself, do not expect that there is going to be a major earnings contributor. In fact, I do think that there is room for margins expectations to be revised downwards on the back of these price-cutting moves that we've seen from the company.
Bloomberg Intelligence Senior Analyst Catherine Lim there. Well, one of the other stories that we're following, Tesla CEO Elon Musk says a shortage of chips spurred by explosive development in AI is starting to ease. But his warning of new challenges ahead in the supply of transformers and other hardware. Musk spoke in a live discussion on his X platform with Norges Bank Investment Management CEO Nikolai Tangen.
Last year it was about a chip supply. People could not get enough NVIDIA chips particularly. This year is starting to transition to a voltage transformer supply. If you look out a year or two, or certainly 3 years, it's just electricity availability. So those are the constraints on the hardware side.
All right, let's get you some live pictures there. You see Neil Kashkari on the left of your screen there. He is taking questions now in a town hall at the moment. Earlier on, Neil Kashkari, the Minneapolis Fed president, was saying that the labour market is no longer red hot, but is still very tight. He's also saying that the Fed can't stop short on the inflation fight. But the base case is that inflation will continue to fall. So Neil Kashkari now there taking some questions. It was, of course, Neil Kashkari, who doesn't vote on the Fed this year, who was saying just a few days ago that there is a possibility that the Fed might not cut rates at all in 2024. So that surprised a few people. So Neil Kashkari there saying the base case, though, inflation in the US will continue to fall. All right, coming up, we're going to be back live at HSBC's Global Investment Summit in Hong Kong. Guest panel today includes their private banking and wealth CEO, Annabelle Spring, and the former St. Louis Fed President, Jim Bullard. Market opens in Seoul, Tokyo and Sydney up next. This is Bloomberg.